We're going to talk a little bit about accelerated depreciation when it comes to tax incentives. A lot of times you will see in the news that such and such real estate investor only paid 8% tax and their secretary paid 32. This isn't fair, it's not right, we must fix it. Well, one of the tools that they're using is they're depreciating assets, either assets that they use, tools that they use for their business, or most common is going to be depreciating assets like real estate. So I think the first thing to do is explain what depreciation is and how it helps us as individual investors. And then we can talk about how to scale that depreciation up and escalate it through a cost segregation study for predominantly multifamily and commercial real estate. So, first of all, depreciation is an incentive that the IRS has given all Americans. This isn't exclusive to people that are wealthy. This is anyone that owns real estate as an investment. And so I view depreciation as this: you get to depreciate 3.5% of the value of the improved portion of your real estate. So let's just say, for example, to keep the math very, very simple, you have a property that's worth $1.5 million. 500,000 of that is the land itself. So the land is not depreciable. So what you have left is you have $1 million worth of improved assets. So you have windows, drywall, countertops, cabinets, a roof, air conditioner. You have these components inside of the property, and they're going to depreciate over time. The government says we'll give you 3.5% of those improvements to depreciate off of your taxes. So if you have $1 million asset, 3.5% of $1 million is $35,000. Effectively, what that means is I would be able to earn $35,000 before I paid any federal income tax. Does that sort of track? That seems like okay. If I make 100 grand in a year and I have a $35,000 depreciation, now my taxable income is now $65,000. That's the easiest way I think I can break down depreciation. Now I'm using large scale numbers, right? Because I'm decent at math, but I'm better at percentages that make sense, right? So $1 million is easy. Let's scale that down. Let's say it's $100,000. Let's say you own a property that's worth, the improved assets are 100,000. You get a $3,500 tax write-off, right? And if you pay a 30% tax rate effectively, you're going to save that amount of money. Okay. So this is a great tool. Individuals like you, Abram, you're able to depreciate about $27,000 a year before the IRS caps you. Okay. So you could effectively get 3 or 4 residential rental properties and you would be close to hitting that $27,000 depreciation. And if I do the math on 27,000 times, let's say you're at a 35% tax rate, it saves you $9,400. So let's just say you're an investor and year number 1, you use this tool, this depreciation tool, and you save $9,450 on your taxes. Theoretically, you should be investing that $9,450 in the market in some way, either reinvesting it in real estate. $9,450, that's a down payment for a house at 3.5%. Right? So you can use that money and recirculate it into the economy. So that's the basic structure of depreciation. And I hope it's not too confusing because it does get a little abstract, but that's how an average person can use depreciation to their advantage. Hey everyone, Michael here with Absolute Real Estate. Thank you for watching. Do me a favor, like and subscribe below. And if you want more information on real estate and real estate investing, check out the links below and I'll see you on the next video.